All right, good afternoon, Insignio. Today's February 4th. We're joined by John Forelli, who's a portfolio manager with Boston Partners. Welcome to the show.
Thank you very much.
Well, I'm your host. I'm Alejandro Guardiola. I'm on the investment solutions team, and we have an exciting agenda in front of us today. John is responsible for managing several different strategies within Boston Partners, and they would describe themselves as value investors. Tell us a little bit about the last 5 years in the scheme of value and growth.
Sure. So the last 5 years has been very much of a growth-driven market, except for the year 2022. So aside from that, we've been very much in a market where the Magnificent Seven, the large cap, the mega cap growth companies in the U.S. have outperformed. Investors have become very interested in, they've become very expensive at the same time. But there is a reminder in 2022, what can happen when the market moves against them. That year, the S&P was down 18%. This group of stocks were down over 25%. And value portfolios were down about 5%. So much better opportunity to protect capital. But investors are greedy, and they've remembered that over the last few years, growth has been the place to be, and it's hard to get some love for value stocks these days.
Sure, but that's in many ways that's enough to get one excited.
Right? That creates the opportunity.
Sure. If we look at historical percentiles of where stocks are trading today, we're at extremes, historically speaking.
Yeah. So when we look at growth companies today, they are about as expensive as they have ever been. They are trading at large cap growth companies are trading at about a 50% premium to what they historically have traded over the last 40 years.
Mm-hmm.
While value companies are fairly valued to a discount of about 10% relative to where they've been over the last 3 years. So very much a bifurcated market where we've got growth very expensive, we got value appropriately valued to inexpensive relative to history.
And when we look at history, periods when we've seen growth diverge from value by this much, what have the next subsequent years looked like?
Yeah, so the next 10 years, when we've seen such a valuation discrepancy like we do today, over the next 10 years, we've seen a 2.7 per year outperformance of value over growth each year for 10 years. So it looks like an opportune time for value stocks today.
Absolutely the case. We're going into a new regime, and that's saying it lightly, right? It's a totally new regime. What areas are you guys most excited about?
Yeah, so it's interesting with the new governmental regime. It's hard to really predict what's going to happen when it's coming out of Washington these days. But I'd say one area that we're very much excited about is the financial sector. We're seeing net interest margins expanding because we're finally seeing a positively sloping yield curve. We've been in negatively sloping curve environment for a while.
Sure.
We're in a fairly steady to strong economic environment, which means we don't have to worry too much about credit quality. We're seeing deregulation potentially in the financial sector as a result of the new administration, which would allow some of the larger financial institutions to return more cash to shareholders through share repurchases and increased dividends. All very good uses of capital. And if there is more M&A activity, that will certainly help the capital markets companies with more M&A activity.
M&A activity and IPO kind of calendar over the last few years has been fairly muted.
Really light, yeah, because the Democratic administration did not really encourage consolidation, and that has kind of hamstrung the market for both IPOs as well as some mergers not being allowed to go through as a result of the government.
Certainly, and earlier today there were some really good points you made as far as like pendulum swinging. So in the middle is fair value, but we're hardly ever exactly at fair value, right? We look at how many rate cuts the market was pricing in last year, and then this year they wrong, and then wrong on the other side, and so there's a happy medium in the middle.
Yeah, exactly. I'd say as far as the economic outlook, right now we would personally expect the Fed to cut rates probably 2 or 3 times in 2025, while the expectations for the market today it's more like one cut for the year, and that seems a bit pessimistic to us.
Yeah.
It's going to be very closely related to what happens to inflation, and we're believers that inflation will come down a bit in 2025 to somewhere between, somewhere in the 2.5% range from about 3% today.
Sure. So recently we've heard a lot about tariffs, and at the margin, it seems that could certainly be inflationary. Is that the base case?
Yeah, I think that's the base case, and I think the Fed is on hold right now, partly because they are not certain what's going to happen out of the tariff negotiations and how inflationary that might be. So it wouldn't surprise us to see the Fed on hold maybe through June of this year.
Sure.
Try to sort that all out.
And it's anybody's guess as to what actually becomes, or if it was just a bargaining tactic, et cetera. So a lot of uncertainty in that camp.
Yeah, without a doubt. You can see that in yesterday's stock market. The market was down big at the open, and then it was up in the and by lunchtime, and then down modestly by the end of the day, all based upon tariff news.
Sure. So with that volatility, do you guys treat it fairly actively for adding or trimming names that you love or want to hold?
Yeah. So if we saw some big moves in the stock we already own based upon speculation of a tariff issue, we'd probably take advantage of that and add to that position.
Sure.
But it's hard to make too many investment decisions because you don't know at this point what the level of tariffs might be. And then on top of that, how long they might last. They could last weeks or a month or two, which would not change our investment outlook. But if we knew that we're going to continue for 2 years, for instance, we would potentially change our outlooks for companies.
Certainly. And one way that I guess the market would react is kind of that first level order of understanding. Tariffs, inflationary, okay, like Econ 101. What about the second and third level order effects of, the incentives that might be created for other players to bypass certain, supply chains that would, longer term be disinflationary.
Right.
And weighing those, forces.
Those are more typically longer term issues. So let's say the concept of onshoring. As a result of these tariffs, people bring more manufacturing to the US. That could offset some of these issues and then bring more growth to the US, but that's more of a medium term issue. Probably would not affect our economic outlook over the next couple of years. But we have to balance all of these issues around tariffs and what kind of effect it might have on the market.
Would you say that given where we are today, the news cycle of how we're going to be reacting and deciphering news has shortened the kind of the horizon, or you guys are long-term players and some of the noise, the quarterly noise is essentially that is noise?
Yeah, I would say in general, we will look to take advantage of companies that get punished in the short term over headline news that has a low probability of actually being enacted. And on the other hand, if we ever see a big pop in the stock because of a potential outcome, that might be an advantage to sell some stocks as they reach our price targets.
Amazing. Do you want to walk us through an example of this January, a name that was, added on some of this volatility?
Yeah, so maybe not exactly on this volatility, but I'll talk about the airline stocks. So airline stocks are typically a pretty volatile sector, and an area that doesn't necessarily have the quality that we look for sometimes in our holdings. But what we've noticed here over the last decade or so is when the capacity growth of airlines is less than the GDP growth of the US, that's an opportunity for airline companies to expand their margins, generate lots of free cash flow, and potentially return some cash to shareholders through either dividend increases or share repurchases. And what we've noticed here this year is that we've seen some of the low-cost carriers like Spirit Air file for bankruptcy, which is reducing the capacity for the low-cost airlines, which is giving the bigger airlines an opportunity to raise their prices. And then in addition to that, capacity has been constrained because Boeing and Airbus have not been able to deliver their planes due to manufacturing delays. So all in all, we're expecting capacity growth in the US air fleet to be less than 1% this year. We're expecting GDP growth to be somewhere between 2 and 2.5% this year. That should be an environment that should be right for the airlines to really expand their margins and generate some good positive surprises for earnings.
You guys have a positive outlook on United. Is that kind of the?
Yeah, United Airlines, and we also recently purchased them.
Okay, United and Delta. Would you look at air travel as a good leading indicator of economic strength? We're seeing people are traveling.
Yeah,
Right.
definitely.
Yeah.
And, certainly, we're back to work. We're back to going to conferences. We have, put the COVID environment behind us. I think
Right.
officially.
That's great. At Boston Partners, we have a handful of strategies. Okay, and just looking at some of the overlap, it doesn't seem that there's a lot. There's actually some really good differentiation in the strategies. Let's dissect a little bit the U.S. large cap fund. Give us the synopsis. How many holdings? What themes are expressing themselves in that portfolio?
So our approach to investing in Boston Partners is a three-pronged approach. Call it a three circles approach. We want to create portfolios that are less expensive than our benchmark, lower PE ratios, higher free cash flow yields. We're believers that lower valuation securities outperform higher valuation securities. We also want to buy high quality companies whose fundamentals are improving, high and improving returns on invested capital, companies that are becoming more efficient, more profitable over time, outperforming the equity markets over time. And then finally, if you can find those inexpensive, high quality companies with improving business momentum, it's the third leg to the stool. Looking for companies that are meeting and exceeding revenue, earnings, and cash flow expectations of investors and raising estimates over time. You can create portfolios with those three characteristics. We have a good chance of outperforming our benchmarks over time. In the large cap portfolio today, that's typically a portfolio that has somewhere between 70 and 100 holdings. Today, we have about 80 holdings in the portfolio. Our positioning is very strong along those characteristics, very high quality in the portfolio. Portfolio trades at about 15 times earnings, which is a discount to the 16 times of the benchmark, which is the Russell 1000 value benchmark, or the S&P 500, which is trading about 21 times earnings. So a significant discount.
Sure.
And then we've got the companies that are very high quality, very high operating returns on assets and returns on invested capital. And then at the same time, they're meeting and exceeding earnings expectations. So very well set up along these three characteristics. I'd say some of the sectors that are most favored for us today would be the financial sector would be a strong area for us.
Okay. It's fun it was.
So the financial sector would be a strong area for us. We're also overweight the industrial sector in the portfolio. Those are probably two of our favorites right now. And then within technology, more lower growth technology companies, not the big high growth mega cap tech companies, but some good opportunities within technology as well.
Do you see some rotation now from hardware to software becoming prevalent? Hardware's had a good
Yeah, I'd say particularly semiconductors towards software. Semiconductors tend to be a more cyclical portion of the technology market, while software tends to be much more steady earnings growth. And we're becoming much more interested in software companies today and looking for that steadiness and the predictability as we've seen some inventory corrections in the industrial side of semiconductors. And we've been lightening up on those positions and looking more for software.
Great. Okay, turning our eyes to the U.S. Select Opportunities Fund, comparing and contrasting benchmark holdings and themes that are coming to light there.
Yeah, so first of all, as an asset class, we really like the mid-cap asset class.
Sure.
Since 1999, mid-cap stocks have returned about 790%, compared to large cap stocks, which have returned about 540%. This is on a cumulative basis. So they've outperformed since 1999. And they've done it on a more consistent basis. So if you look at the hit rates of their ability to outperform over rolling 1, 3, 5, and 10-year time periods, anywhere from 53 to 70% of the time, mid-cap has outperformed large caps, been consistent outperformance. And right now, they're kind of unloved. If you look at the large cap benchmarks, mid-cap companies make up the smallest portion of the the large cap benchmarks than they have since 1964 over the history of the strategy. So And on top of that, valuation is very attractive.
Certainly.
The average mid-cap company trades at about a 10% discount relative to where it has traded on a PE basis over the last 40 years. While large cap growth companies are trading currently at about a 50% premium to where they're traded over the last 40 years. So there's a huge valuation discrepancy. Mid-cap companies grow faster than large cap companies because they're smaller and more nimble. Geographic expansion. They also have basically virtually, no bankruptcy risk relative to small cap companies. Today, small cap companies, 42% of small cap companies are not earning money today.
Sure. So negative earnings.
Negative earnings.
Yeah.
And call us old fashioned, but we like to invest in companies that have earnings and cash flow. So less bankruptcy risk there. And then finally, the mid-cap companies also make nice takeover candidates for large cap companies looking to grow. And typically in an average year, this portfolio has somewhere between 3 and 5 takeovers per year, which helps boost returns.
Correct.
As well. So we think it's a really strong asset class. Within the portfolio itself, it trades at a little bit of a premium to our large cap portfolio. It trades at about 16 times earnings compared to 15 times for the other portfolio, but a much higher operating returns on assets, a higher quality portfolio. In fact, this is amongst the highest quality mid-cap portfolio we've ever had. With very positive business momentum. The leading sector in that portfolio would be the industrial sector, where we very much like aerospace and defense companies. On the defense side, as a result of the global conflicts that we've had, unfortunately, we're seeing defense spending increase in the US, in the European countries, and also Japan is doubling their defense spending over the next 5 years. So very strong, order growth there, and then there's very good predictability on those orders. Those are multi-year contracts that you get. And then in addition to that, on the aerospace side, as Airbus and Boeing begin to deliver their planes, we're going to see additional business opportunities for the mid-cap industrial companies in the aerospace area. And then one final area within industrials, which is a fairly diversified sector, the theme of electrification. We're seeing more battery operated devices. We're seeing more electric cars. These are creating very good opportunities for the industrial component makers involved in that value chain.
So interestingly, last year, our CIO came out and we were making a strong call to look at equal weighted versus market cap weighted. And tell us a little bit about what the work that you've done to show when things actually turn in that space and how that persists and how that can persist over some years.
Yeah. So the returns of the cap weighted S&P 500 relative to the equal weighted S&P 500 over the last 2 years, cap weight has outperformed equal weight by 12% or more per year for the last 2 years. We've only noticed 2 time periods going back to the 70s when we've seen such outperformance, and it wasn't even to that degree of cap weighted versus equal weighted, and that would be the tech bubble of 98, 99, and also the Nifty 50 era of 1972 and 73.
When it came to a screeching halt.
Right. And what we noticed for the next 6 years after the 2 year of outperformance of the cap weighted portfolio, the next 6 years equal weighted outperformed cap weighted each year for the next 6
years.
So it feels like we're setting ourselves up for a similar environment today.
And coming from a more dislocated comparison, really, because like market cap has completely dominated. So I mean, the starting point is even more distressed, so to speak.
Exactly. So if we're shifting from a concentrated market environment to a broader market environment, we would expect that to help smaller and mid-cap companies relative to mega-cap companies from a capitalization standpoint. And from a style standpoint, we would expect value to outperform growth, as it's been the mega-cap growth companies that have been the leaders in the marketplace, been responsible for those concentrated returns.
We've seen a little bit of a snapback fourth quarter last year of market cap giving ground up to equal weighting. Is that
Yes,
a fair statement?
So on a year-to-date basis, we're definitely seeing some broadening of the market.
Sure.
We saw that in the third quarter. It reversed again in the fourth quarter. So it's too early to call it a trend.
Sure.
But perhaps we're at the beginning of the shift.
So mathematically, we can arrive there two ways. Either market cap weight starts going down more than equal weight, or equal weight performs, well, and market cap kind of,
Right.
just kind of get, the.
Yeah, I can go back to the history of what happened after the tech bubble. After the tech bubble, value stocks that basically modestly outperformed, or maybe modestly went up, and you got a mid-single digit return there, versus the mega cap growth favorites, which were down substantially. So if that history repeats itself, I would expect more of a, we saw what happened to NVIDIA earlier this week. It was a 17% move on the rumor of a competitor having a more efficient way to solve AI. We don't know if it's commercial or not, but small pieces of information can really affect the valuation of these very large, expensive companies.
Are you surprised it's taken this long for there to be some news of, hey, we can do it better, cheaper, faster?
I'd say we're surprised that the mega cap growth companies have maintained their dominance for as long as they have.
Sure.
These companies are getting more capital intensive. Their valuations are close to astronomical. NVIDIA today trades at 28 times revenues. Like, as value investors, we wouldn't consider buying a company for 28 times earnings.
Right.
And many of the other mega cap favorites are trading at 10 times revenues or more. These are just, valuations that don't make sense to us. The average company in our portfolio trades at about 3 times revenues, just to give it as a perspective there.
It's, the good old quote about how long the market can stay irrational, right?
Right, exactly.
Or so in 95 through 99, so we get to 97, we look back and we had huge gains in 95, 96. Rational investors would say, hey, it's time to, start rotating. Market rips for another 3 years, and we get into extreme bubble territory. Are there some, fears or some, inklings that this could turn into a scenario this way of a couple more years of just irrational exuberance? Let's pick another,
Yeah, it's a hard thing to say. I'd say over the last 14 years, growth has had leadership almost the entire time, except for 2021 to 2022, maybe an 18-month time period in there.
Sure.
So this growth run has actually been more extreme than the growth run of the late 90s already.
Yeah.
So it feels overdue, but I would have said the same thing a year ago. So
fair. We've unpacked 2 funds. You guys have a suite of value, core blend, and still growth themes. If you had to pick one fund to express Boston Partners' best ideas, so that investors wouldn't have to decide themselves and just kind of allocate and go for the ride, where would you point our attention to?
yeah, so I'd say the U.S. premium strategy would be one that I would encourage investors to look at, particularly if you're looking for broad exposure to U.S. value companies. You want to take advantage of this trend. Our U.S. premium strategy is an all-cap strategy. We will look for our opportunities within the large, mid, and small cap space. We will shift around our allocation to those different capitalizations depending upon where the opportunities are. So in a sense, we take the decision out of the advisor's hands from which capitalization do we think is going to outperform this year. Leave that to Boston Partners, who will make that decision on a bottoms-up basis depending upon where we are finding relative valuation in the market. Today, that portfolio is the most overweight mid-cap relative to where it's been historically.
Okay.
We have about 44% of the portfolio in mid-cap today. We typically have in the 30 to 35% range in mid-cap. It's mostly at the expense of large cap, which is typically in the 50 to 60% range. I think it's 47% today.
Okay.
And then the remainder is in small cap today, which is about the average of where we've had it historically, which is about 9% of the portfolio.
And to be clear, so it's under the bucket Robeco US Premium Equity Fund. Of the Mag 7, How many of the Mag 7 are in that portfolio?
We own Alphabet in the portfolio,
Okay,
which is the least expensive of the Mag 7 stocks. It trades at a slight discount to the S&P 500, to the broader market. Very high quality. It's on the top end of valuation where we're kind of comfortable.
okay,
At about 22 times earnings. Our portfolio, this portfolio trades at about 13 and a half times earnings. But the quality and the predictability of earnings have been so strong here over the last few years that it has still earned a spot in our portfolio.
amazing. We are coming up on our 30 minutes of allocated time. It's time flies when you're having fun. I'll leave you with last thoughts for investors and advisors that are launching the program. When we think about Boston Partners, final words.
Okay, so final words, I would say value looks like a very good opportunity today. Growth certainly looks expensive relative to value. The concentration of the broader US market makes us nervous, where you've got such a small number of companies, 7 companies making up more than a third of the US market cap today. It feels like it's kind of gone too far. There's a big valuation advantage on value relative to growth historically. We're finding no shortage of new ideas for value portfolios today. And it just feels like it's the right time that the rubber band got stretched too far. It's time for value to come back relative to growth in the US marketplace.
Amazing. And we would agree. Our house view it actually lines up like squarely with what we discussed today.
Excellent.
Thank you for being on the show.
Thank you very much, Alejandro.
Thank you.
Insignia Financial Group, LLC comprises a number of operating businesses engaged in the offering of brokerage and advisory products and services in various jurisdictions, principally in Latin America. Brokerage products and services are offered through Insignia International Financial Services, LLC, headquartered in Puerto Rico, and through Insignia Securities, LLC, headquartered in Miami. Both are members of the Financial Industry Regulatory Authority, FINRA, and Securities Investors Protection Corporation, SIPC. Investment advisory products and services are offered through Insignia Advisory Services, LLC, an investment advisor registered with the Securities and Exchange Commission. In Uruguay, advisory services are offered through Insignia International Asesores de Inversión Uruguay, SA, Insignia Asesores de Inversión Latam, SRL, and Insignia Asesores de Inversión de Uruguay, SRL, in Argentina, and through Insignia Argentina, SAU, and in Chile through Insignia Asesorías Financieras, SPA. Collectively, these 8 operating businesses make up the Insignia Financial Group. To learn more about the broker-dealers, including their conflicts of interest and compensation practices, please go to https://insignia.com/disclosures/ or via www.finra.org. To learn about Insignia Advisory Services and any conflicts related to its advisory services, please see its Form ADV and brochure, which can be found at Investment Public Advisor Public Disclosures website, https://